In this video, I'll examine how investors should analyze income statement earnings quality. I will pose certain questions the investor should be asking, discuss how to perform a common size analysis, a ratio analysis, and identify red flags to look for. Whether you're an investor or a business owner trying to understand how your business is performing, knowing how to perform an earnings quality analysis is essential for making informed investment decisions or improving your company's performance. Join me as I break down the steps to a great income statement analysis. By the end of this video, you will have the tools and knowledge to effectively assess a company's financial performance and identify strengths and weaknesses in a company's performance. This will help you to make smarter investment choices and business decisions. Don't miss out on this essential guide for investors and business owners. Make sure to like, subscribe, and hit the notification bell for more financial literacy content. Join us on this journey to becoming a more savvy investor and business owner. Earnings quality analysis helps to gauge the quality of a company's earnings, helps investors make better investment decisions. High-quality earnings are from the core business and are sustainable. Low-quality earnings are from non-core operations and are not sustainable. The earnings quality analysis process. Step 1. Answer the following questions. Source of earnings. Are earnings from the core business? Earnings sustainability. Are earnings recurring or non-recurring? Earnings management. To what extent are earnings subject to management judgment? Are earnings being converted to cash in a reasonable time? Let's address the first question. Are earnings from the core business? Core sources of earnings include sales demand in the normal course of business, pricing power, being able to charge more for your products, product mix, selling multiple products, and new contracts. Earnings from core sources are high in quality. Non-core sources of earnings include foreign currency changes, lower taxes, lower interest expense, non-recurring income or expense, accounting changes in acquisitions. Earnings from non-core sources are lower quality. Question 2. Are earnings recurring or non-recurring? Recurring earnings are higher quality than non-recurring earnings, or one-off sources of earnings. Recurring earnings are earnings from normal, ongoing business activities, for example, sales of inventories. Recurring earnings are sustainable. Non-recurring earnings are from one-time activities, for example, one-time liquidation of old inventories. These types of earnings are not sustainable and are therefore of lower quality. The third question is, to what extent are earnings subject to management judgment? Earnings management occurs when companies dress up the financial statements to show desired operating results. All financial statements require estimates and assumptions, which require management judgment. Earnings are therefore subject to management judgment. The opportunity for earnings management increases as use of estimates and assumptions increases. Reasons for earnings management. Companies manage earnings for several reasons: to meet Wall Street analysts' earnings estimates, to achieve bonus targets, to present better financial results to investors, lenders, buyers, and other stakeholders. Red flag for earnings management: consistently meeting or just beating analysts' earnings estimates. This could be a sign the company is managing earnings items with significant estimates and assumptions. Here are some things to look for when analyzing the financial statements that could lead to earnings quality issues. These are items that companies could potentially manipulate to manage their earnings. Under revenue recognition, look for the following 4 things. 1. Percentage of completion. 2. Gross versus net recognition. 3. Multiple performance obligations. 4. Sales to distributors, which can lead to channel stuffing. Accounting reserves. Accounting reserves can be used to create a cookie jar when the company is performing well, to be later emptied for an earnings boost when times are bad. Review the reserve roll forward on Schedule 2 in the 10-K. Acquisitions. Look for the following 3 things when a company acquires another one. 1. Fair value estimates. 2. The percentage of the purchase price allocated to goodwill. And 3. Contingent consideration, reserves. Here are some things to look for when analyzing reserves for earnings quality. Falling reserves as a percent of the related asset. For example, falling bad debt allowance as a percent of receivables. Compute earnings impact if reserve as a percent of asset is lower than prior year. Recalculate allowance assuming reserve as a percent of asset is the same as prior year. Earnings impact is the difference between the recalculated and reported allowance. Reducing provisions when write-offs are increasing is another earnings management red flag, and provisions less than write-offs. Types of reserves. There are several types of reserves that require management judgment and can be manipulated by management to boost earnings. These include 1. Allowance for doubtful accounts, created for receivables. 2. Loan loss allowance, created for loans, and mostly used by banks and other financial institutions. 3. Obsolescence and LIFO reserves, created for inventories. 4. Sales return allowance, created for revenue. 5. Warranty reserves, created for revenue. 6. Restructuring reserves. 7. Environmental remediation reserves. And 8. Contingencies, acquisitions. Here are some things to look for when analyzing acquisitions for earnings quality issues. Large allocation of purchase price to goodwill. This could mean less of the purchase price is allocated to intangible assets which are amortized to expense each quarter. The higher the amount of the purchase price allocated to goodwill, the lower the quarterly amortization expense and the higher the company's earnings. Post-acquisition change in purchase price allocation. Allocating more of the purchase price to goodwill after the acquisition could also result in lower quarterly amortization expense and provide a boost to earnings. Contingent consideration. This can be used to create a cookie jar, which can be adjusted later to boost earnings. Contingent consideration is a portion of the purchase price in an acquisition that is dependent on the financial performance of the acquired company subsequent to the acquisition. Contingent consideration can be adjusted subsequent to the acquisition. If it is adjusted down because the earnings target is not met, it goes back to the buyer's income statement as a reduction in expense and an increase in earnings. Companies may deliberately allocate too much to contingent consideration, with the intention of reclaiming it in the future to boost earnings. And the fourth and final question is whether the company is converting earnings to cash in a reasonable time. Cash is a company's lifeblood. A company needs cash to pay bills and fund operations. A company will go out of business if it is not generating enough cash. Slow cash collection. This could be a sign the company is recording revenues too soon. The company may have to write off receivables. Slow cash collection lowers operating cash flows. Red flag for earnings quality. Operating cash flow lower than net income. The company may be having trouble collecting cash from sales. The company may be recording revenues too soon. It is a sign of poor earnings quality. Cash flows fluctuate, but over time converge with earnings. Review liquidity section of management's discussion and analysis in the financial statements for what's impacting operating cash flows. Earnings quality issues may exist if there are no reasonable explanations for differences between operating cash flow and net income. Step 2. Common size income statement. Express financial statements in percentage terms. Over multiple periods. There are two types of common size analysis. Vertical and horizontal. Vertical analysis: income statement items expressed as percent of revenues. Balance sheet items expressed as percent of assets. For example, cost of sales falling as a percent of revenue. The company may be managing costs to meet earnings targets. Horizontal analysis: change in financial statement items year over year. For example, cost of sales increased over prior year. Find out what's causing this. What to look for in common size analysis: trends and relationships between items. For example, sales growth in relation to receivables growth. Changes in individual items. For example, inventories increased by 50%. Assess impact on earnings, balance sheet and cash flows. Assess management explanations for reasonableness. Red flags. Here are some red flags to look for when doing common size analysis. Receivables growing faster than sales. The company could be recording revenue too fast. It may suggest receivables collection problems, possible bad debts. Red flag. Inventories growing faster than sales or cost of sales. This could be a sign of excess or obsolete inventories. Risk of inventory write-offs. The risk is higher if the increase is in finished goods. costs possibly not charged on some sales. Red flag. Reserves as a percent of assets increase. This could be a cookie jar. Red flag. Reserves as a percent of assets decrease, emptying the cookie jar, earnings boost. Red flag. Long-term debt increase and interest expense decrease, capitalizing interest. When interest is capitalized, less of it is expensed, and this increases income. Red flag. Operating expense as a percent of sales decrease, capitalizing operating expenses. When operating expense is capitalized, less of it is expensed, and this increases income. Step 3. Ratio analysis. Ratio analysis is used to examine the relationship between financial statement items. Identify financial statement risks. You should review ratios for large, unusual changes. Example: days sales in receivables increased meaningfully for 3 years, then fell in year 4. Falling DSOs means quicker receivables collection. The company may have sold receivables. The company may have moved receivables to another account, perhaps inappropriately. Receivables sold may be excluded from DSOs. Receivables are usually sold at a discount. The company could be on the hook for losses if it sells receivables. No real improvement in DSOs if receivables sold or moved. Asset-liability turnover ratios measure how efficiently a company is managing its assets and liabilities. For example, days inventory outstanding. Number of days to sell inventories. Days payable outstanding. Number of days to pay creditors. Profitability ratios measure a company's ability to generate profits. For example, operating margin, sales less operating expenses. Solvency ratios analyze capital structure, that is, the level of debt and equity used to fund operations. For example, debt to equity ratio, debt as a percent of total equity. Earnings quality. The key issue in earnings quality analysis is whether operating results are from the core business and are sustainable. Profitability and asset-liability turnover ratios are best for analyzing earnings quality. Peer analysis. Ratios significantly different from peers' ratios may suggest operational risks. Here are some examples of earnings quality ratios. Gross profit margin. Gross profit divided by revenue. This is a profitability ratio. It tells whether sales covers cost of sales. A red flag is if the ratio is falling, growing too quickly, or is volatile. Operating margin. This is another profitability ratio. It is calculated as operating income divided by revenue. It tells whether sales covers operating costs. A red flag is if the ratio is falling, growing too quickly, or is volatile. Cash flow to net income. This is both a profitability and a liquidity ratio. It is calculated as operating cash flow divided by net income. It tells how quickly earnings are being converted to cash. A red flag is if the ratio is below 1. This means cash flow is lagging earnings, and could be a sign the company is having issues collecting its receivables or recognized revenue without meeting the accounting criteria for recognition. Days sales outstanding. This is an asset turnover ratio and is calculated as receivables divided by revenue divided by 365. It tells the number of days a company takes to collect its receivables. A higher number means a company is taking longer to collect its receivables. Large swings in this ratio could mean a company is having issues collecting its receivables or recognized revenue without meeting the accounting criteria for recognition. Days inventory outstanding. This is an asset turnover ratio and is calculated as inventories divided by cost of sales divided by 365. It tells the number of days a company takes to convert its goods to cash. A higher number means a company is taking longer to convert goods to cash. Large swings in this ratio could signal a company is having problems with its inventories, which could lead to write-offs for obsolescence or long-held inventories. Step 4. Put it all together. Combine findings from steps 1 to 3. Assess overall earnings quality. Create a report that summarizes the findings from your earnings quality analysis. This will later be combined with your balance sheet and cash flow quality analyses, which I will be covering in a future video. And that brings me to the end of the video. Thanks for watching, and remember to like, share and subscribe. And I will see you in the next video.